Welcome to the weekly recap for the week ending April 5th. And this time I'm actually going to be going through the past 2 weeks because I missed last week's recap. So I'll be diving through the various news topics over the past couple of weeks, and let's get to it. So first up, we have the summary of global markets. As you can see, over the past week, there were a lot of rallies across the board. Except in bond markets where we saw a slight pullback. Let's take a closer look into growth markets, and you'll note that the S&P 500 rallied throughout this past week, ending up 2.16% for the week, with a further 3.34% in total over the past 2 weeks. Jobs numbers were also up in March, showing the U.S. economy added 196,000 new jobs during the month versus the final number of 33,000 in February. This generally shows that the numbers in February were much more likely to be an anomaly versus some foreboding indicator of where the United States economy is headed at the moment. The UK also requested another Brexit delay to push back the date from April 12th to June 30th. EU officials in the EU Parliament are still deciding on the best course of action that they'll be taking with regard to Brexit. Trade talks have also progressed between the US and China, with President Trump indicating that the two countries may come to an agreement in the coming weeks, an agreement which he described as epic. However, no date has been set for a summit between our two nations' leaders. Now, when we look at year-to-date returns here, we see that real estate and the Russell 2000 small cap stocks are the leaders in the growth markets, with commodities taking up the last place down there. When we look at bond markets, now bond markets have been much the talk over the past several weeks, with the yield curve inversion, with the 3-month and 10-year spread inverting and then uninverting on March 29th, the 3-month and 10-year spread uninverted after inverting throughout the latter half of the month of March. And the 10 years yield increased to 2.41% as the 3 months declined to 2.4%. So we saw a very slim upward curve to the yield curve. Now, as mentioned in previous recaps when I've been talking about the yield curve, now while the yield curve was inverted for several days, and yield curve inversions in the past have heralded recessions within a couple of years, that doesn't necessarily mean that a recession is a sure thing. Again, the yield curve is made up of multiple yields: the 1 month, 3 month, 1 year, 2 year, 5 year, 10 year, and so on. There are several others. But a yield curve inversion typically looks at the spread between the shorter maturity bonds and the 10 year. And what we saw in March was a partial inversion of the yield curve, and only for a short time. Now, usually yield curve inversions that herald a recession are sustained for multiple months and across multiple spreads. So the 3-month and the 10-year, and the Fed's favorite measure, the 2-year and the 10-year, as well as several others. Now, the yield curve can invert due to changes in expectations of interest rates by bond market participants, not necessarily expecting a recession, but especially in this post-quantitative easing world when all eyes are on the Federal Reserve's movements, strictly because of speculation about where the Fed is going to take interest rates. So this might occur again, but it's difficult to say how impactful it will really be, and whether it's due to a declining economic environment or movements due to the Federal Reserve's actions. Additionally, a full inversion of the yield curve would be a much more impactful set of indicators. So if we see multiple spreads inverting, that will be much more of a confirmation of sorts that the yield curve is that the bond market is expecting more recessionary things in the future. But again, it can be strictly a response to the Federal Reserve's manipulations of the interest rate markets, which all central banks now are much more involved in the bond markets and in interest rate policy than they have been in the past, which can distort things as compared to the indicators prior to previous recessions. So when we look at, as you can see, the past couple of weeks, high yield bonds very much linked to the stock market. Those rose the most, with everything pretty much either flat or falling over the past couple of weeks. When we look at year to date, we see that high yield bonds, again, very linked to the stock market. They've rallied the most year to date, with 10-year treasuries having a much more muted response versus the others. Now, when we're looking at sector returns, over the past 2 weeks, of the main sectors, materials and industrials led the way with returns of over 6.4% and 5.5%, respectively, followed closely by consumer discretionary and the financial sector. And financials are typically helped by an increase in longer-term interest rates. And as interest rates increase, even slightly, typically so do the margins for financial institutions involved in banking. But we saw more traditionally defensive sectors like consumer staples and utilities down there at the bottom. So it really was much more of a risk-on type environment over the past 2 weeks, after many of the worries about the jobs market, as well as worries about slowdowns in the European Union and the central banks, both in the EU and the United States, the Federal Reserve, their responses to all of this. So basically a little bit of a change in pace and expectation as to what the bond market expects over the next couple of years. Okay, when we're looking at trends in the markets, in the major markets, we've seen both the S&P 500's 50-day simple moving average peek its head above its 200-day simple moving average brethren. And the same goes for the international developed, with the asset class's 50-day finally above its 200-day, having been below it since last summer. Bonds, both domestic and international, saw a slight decline from their overbought state as interest rates creeped up slightly, subsequently driving bond prices down. As you can see, they were fairly overbought there before declining, and the same goes for international bonds. But there really was a crowding into bonds due to a lot of the worries, in recent months, as well as the drive down of interest rates as people expect the Federal Reserve to continue its quantitative or a more neutral stance and potentially increase some quantitative easing, or just simply stop the normalization of its balance sheet. We're seeing here much more green on the board, with Japan the only market in neutral territory on the bullish scale here. Pretty much everything else, as you can see, is in much more positive territory, with many increases since the beginning of the prior month. When we're looking at benchmarks, here's the weekly update for the benchmarks tracked in the monthly update. We have the growth, the income, the US equity, and the blended benchmarks. These can be seen down at the bottom left-hand corner of the screen. And here is just a nice summary of some of the major markets that we covered here. The 5-day, 10-day. 10-day corresponds, 5-day corresponds to 1 week, 10-day, 2 weeks. So what we covered today were the 10-day returns in those graphs for the shorter term graphs that we were looking at. Thank you very much for watching. I hope to get out the not only March performance update, but the February update that was never sent out during last month. I will be getting both of those done in the coming days. And I'm really excited on everything that I've been building recently and working on. I really am looking forward to sharing more of it with you as I'm getting all of it built. So I've been teasing some videos and all of that, but they will be coming soon, and I'll give you some more insight to what I've been doing to really make the portfolios way more robust and really build up a moat around your portfolios that is even more robust than it has been in the past. Anyway, thank you again for watching, and I will speak to you soon.